F. Scott Fitzgerald has said many things, but he's known for having said that the test of a first-rate intelligence is the ability to hold two opposed ideas in the mind at the same time and still retain the ability to function. And I think this is true in life in general, but it's especially true when you're navigating a complex system like the market where truly anything can happen. And so the idea is to be open-minded to what might happen and then just respond to what is happening. And I find that that's always true to be the best way to navigate complexity, but it's definitely true, for me anyways, the best way to navigate the market itself, which is perhaps the best example of complexity we have. So many long-term charts today are at bearish extremes, but they've been extreme for a long time. We've ignored them for 2 years, and I'll explain to you why we have. But more importantly, why do they matter now? If you know me, you know that my view is that the market is the best fundamental analyst in the business, which is why it is so hard to beat. And so therefore, our edge, I believe, comes from our ability to listen to the market's message better than others. And not only being able to listen to it, but actually do what it says and kind of check our ego at the door and just listen to what the market says and have and refine a better process than others in terms of how to listen to it, but then listen to it. When it speaks, listen, don't argue, right? These bearish long-term charts that I'm about to show you, that none of them have escaped the market's awareness. It's not like I'm going to show you something that the market doesn't know. But that's the point. Since the last bear market, 2022, the market's chosen to ignore these extremes as they've gotten more and more extreme until this year. Let's start with where we are historically in terms of extremes. There's many charts that I can show, but I think this is perhaps one of the most important ones. And this is basically showing us how big the largest company is relative to one of the smallest companies in the market. So how do I explain that? So if you, let's just say by way of example that there's 100 companies in the market, and if you were to bucket those 100 companies into four different buckets, the top bucket would have the 25 largest companies, and then all the way down to the bottom where you'd have the 25 smallest companies. What this chart is showing you is a ratio between the size of the biggest company in the biggest bucket relative to the biggest company in the smallest bucket. And so what you're looking at basically is just a simple ratio between the biggest stock and the smallest stock. And obviously, when this ratio is going up, that big stock is getting bigger relative to the size of the smaller stock. And what we see in history is that this can actually happen because of two different things, completely different things, quite frankly. One would be a bubble, and the other would be a crash. And you see this ratio going to extremes in both of those cases. So in the past, when we've gone to extremes, it's been in bubbles, like the Nifty 50 in the dot-com bubble. And it's basically everything's going up, but the stuff that's going up the most is attracting the most capital, and the companies just become bigger and bigger and bigger relative to their counterparts within the same index. And again, that's typical at the end of stock market bubbles. But we also see them at crashes. And you say, well, how can that be? How can that be? It's because it's the opposite. It's still a ratio. It's still the same ratio. The difference is that the small stock just gets smaller and smaller at a much more rapid pace. So basically, in a crash, you have a lot of stocks that go to $1, which makes the ratio between these two skyrocket like this. So the biggest company, even though it's going down, it's not going down nearly as fast as the smallest company to crash. So you end up with these stocks, this ratio going to an extreme also during crashes. And so we have to ask ourselves, well, where are we today? Right? We know for sure that we're at the most extreme this ratio has ever been, and I think most of us would agree that we are not in the middle of a crash. So it's likely that this is more symptomatic of a bubble type environment, and now we have to ask ourselves, is it different this time? That's the most dangerous phrase to utter in investing, perhaps in life, but definitely investing. So whenever you find yourself trying to say, well, it's different this time, you're justifying the fact that the largest company is so big relative to everything else. And just be careful about that. I'm not saying it's wrong. I would never say anybody's wrong, but that's just something to keep in the back of your mind. Don't want to be arrogant about it. Also, going to extremes is the investor allocation into equity. So this is a long-term chart. If you look at the scale, it's back to 1952. And when this dark blue line is equities, I guess one of the alternatives for investing is equities. The other one is debt, and the other is cash. And when equities become such a large part of the investor portfolio, that has tended to happen after very large run-ups in equities. And this makes sense, right? Like during a crash in stocks, nobody's making equities their biggest position. This stuff only happens at the end of large moves in equities. And we can see where we are in context today, all the way back to the 1950s. This is the highest allocation to equities we've ever had. And when you drill down on the foreign holdings aspect of that equation, you have once again you have going back in history, back to the 1950s, the Nifty 50 allocation, the internet bubble allocation, and the current Mag 7 allocation. And this is again, this is just American exceptionalism once again. This is not the first time we've been here, won't be the last, but it also won't be the last time that the US stock market is in the bottom of the dumps because it's happened before. It will happen again just because of the nature of how things work. So this is an extreme. And when you just think about it, what's the most likely, what's baked into prices right now? And how much risk is there, room for error is there, or misjudgment is there when you're this extreme? Now, all of this, as I just detailed, these are all examples of where we are in terms of extremes in history. Knowing all of this, this is as of March 14th, so a pretty recent chart. And this is from a story from MarketWatch, and it's basically showing us the year-end target for the strategists on Wall Street. And usually there's a few bears on here that have a really, really kind of ridiculous downside target. And then there's some really, really uber bullish people, but you end up with an average. And this, as of recently, because a number of I won't mention who it is on this list because it's not the point. It doesn't really matter. This is a really tough business. So pointing fingers at others is disgraceful in my view. All I want to do is just point out, and the most bearish investor on this list is actually quite bullish. So there's nobody here on this list that's expecting the market to be down by the end of this year. Now think about all the extremes that I just told you. And if I'm right at all about the possibility that things are inflecting negative, not a single Wall Street analyst, strategist on the street is expecting a down market. So the worst case scenario is 9%, and that's an average to slightly better than average return for the market going back to the early 1900s. That's the worst case expected scenario. The best one, of course, is 25%, and the median is a 16% gain. And keep in mind that we just had two back-to-back gains of high double-digit returns. But the idea that we get another high double-digit or high double teens return from here is kind of interesting when you think about what the backdrop looks like. Thank you for watching this clip from our recent webinar titled A Rare Moment in Stock Market History. If you want to stay up to date with what we're thinking and how we're navigating these uncertain times, start your free trial today at motorcmr.com or by clicking the link below.